Hi, Steve Sosnick here with today's Interactive Brokers Morning Market Morsel for Thursday, March 21st. Happy spring, everybody, and the market seems to agree. We seem to have opened a little bit lower and then basically rallied all through the morning. Yesterday's trading was definitely a choppy one where we opened lower. Then the Fed gave what I would call a friendly sounding announcement, certainly on the surface, where they're not likely to raise rates throughout the rest of the year, maybe a quarter of a percentage point next year, and they're going to stop the quantitative tightening in September. Originally, the market liked that and rallied from its lows to its highs. One of my little trading mantras when you see a move like that is always fade the first move from the Fed, because the market tends to overreact. And I think as the rhetoric came out from Powell, the market started to question, oh, wait, why is he actually doing this? Maybe he knows something we don't. And I think, but the FOMO that's been driving the market forward for the last quarter remains in place. There's really a lot to unpack from this. It's very clear that he's worried about international developments, particularly on the trade front. The reason we were lower yesterday is the president came out and said that the China trade deal is not really imminent. I guess there's a negotiating team going over this weekend. But remember, the original date was supposed to be March 27th. We're not even close to that. So now they're pushing back April, May. I remain convinced that whatever trade deal it is a buy the rumor, sell the news. But the longer it gets pushed off, well, the longer you can buy the rumor, right? So I remain very skeptical. I look at the yield curve, which is essentially inverted through much of its range. When I came in to tape this, the SOFR rate, the new Fed funds, was at 247. Most of the rates, you have a 233 in the 5-year, and the 10-year was at 252. Well, that may not be completely inverted throughout the curve, but boy, that's close. And so what is that telling you? The bond market's basically telling you that things are not good, that there's potentially, recessionary conditions even. The inverted yield curve is rarely a good sign for the markets, for the stock markets, but here we continue to power ahead. The other thing to keep in mind is, perhaps that Powell was signaling yesterday, and I think yesterday's market seemed to reflect this, today's doesn't, is that condition, maybe he's not being aggressive on the rate front, maybe he's cutting back the quantitative tightening because he's a little nervous. On the surface, it seemed like a very, the kind of move that would keep the president at bay, right? The Fed's not raising rates and we're going to be, charging ahead here. But I think the subtext was he's very nervous about international conditions and domestic conditions. And I think a data-dependent Fed, be careful what you wish for, because if you're going to get the monetary easing that you might want, it could be because the conditions warrant it, and that's not necessarily the best reasoning. I remain cautious in spite of the fact that today is at least at the time we're doing this, the SPOOs are up about 18, 20 points. The feeling today is resumption of the bullish tendencies. Goodness knows we can't be down 3 days in a row, so we have to show a rally. I think is part of the mentality as well. But I start to worry about all the various cracks that are out there. Yes, markets climb walls of worry. So maybe I'm just the last of the worry warts. But these kind of moves, definitely, I tend to treat them with a bit of skepticism. Trade accordingly. Take care. Bye-bye.